The imposition of tariffs by the United States on foreign goods has had far-reaching effects across various sectors of the economy. While many people view tariffs primarily as trade policies, their impact extends deep into corporate accounting, influencing everything from cost structures to financial reporting. U.S. companies that import goods or materials from abroad have to adjust their financial practices to reflect these changes, and accounting teams are at the forefront of navigating these challenges. In this video, we explore the top 10 ways that tariffs are reshaping U.S. corporate accounting and the steps businesses are taking to adjust. 1. Increased cost of goods sold, COGS. One of the most immediate impacts of tariffs is the increase in the cost of goods sold, COGS. For companies that rely on imported raw materials or finished products, the higher tariffs imposed on foreign goods increase the cost of purchasing those goods. As a result, accounting departments must adjust their COGS calculations to reflect the new, higher import costs. This shift often leads to a re-evaluation of profit margins, pricing strategies, and supply chain contracts to ensure that businesses remain competitive while maintaining profitability. 2. Changes in financial reporting and compliance. Tariffs have a direct impact on financial reporting, particularly in terms of compliance with the Financial Accounting Standards Board (FASB) guidelines. U.S. companies are required to report any changes in the cost structure that could affect financial performance, and tariffs play a significant role in that. When tariffs alter the cost of imported goods, companies must disclose these changes in their financial statements and ensure compliance with accounting regulations. This may involve adjustments to inventory valuations, adjustments in gross margin forecasts, and more detailed footnotes in annual reports. 3. Impact on gross profit margins. Increased tariffs result in higher input costs, which directly impact gross profit margins. Accounting teams need to carefully monitor how rising costs affect overall profitability. This has led many businesses to reconsider their pricing strategies, such as increasing the price of goods sold to maintain margins or finding cost-saving measures elsewhere in the supply chain. For companies with tight profit margins, the ability to adjust quickly is crucial, and accounting departments play a key role in analyzing how tariff changes influence financial results. 4. Revaluation of inventory. The tariffs imposed on imports not only affect the purchase price of goods but also impact the valuation of inventory. When companies import products at higher tariffs, the cost to hold inventory increases, potentially requiring a revaluation of stock on hand. This could lead to adjustments in the carrying value of inventory under the lower of cost or market rule. As a result, businesses may see fluctuations in their reported inventory values, which in turn affect their balance sheets and financial ratios. 5. Changes to cash flow forecasting. Tariffs can also have a significant impact on cash flow forecasting. When importers face higher costs due to tariffs, they often need to adjust their cash flow predictions to account for increased expenditures. This can be particularly challenging for companies that rely on foreign suppliers, as they must navigate fluctuating costs and potential delays. Accurate forecasting becomes more critical as businesses must plan for the higher outlays associated with purchasing imported goods. Accounting departments need to account for this shift in cash flows, making sure that businesses have enough liquidity to manage these new financial pressures. 6. Tax implications and strategic planning. Tariffs also have important tax implications for businesses. Increased costs of goods sold can impact taxable income, as they reduce overall profits. However, businesses may be able to offset these costs through tax strategies, such as claiming deductions or utilizing credits available for certain types of expenses. Companies must work with tax professionals to evaluate how tariff-related expenses affect their tax obligations and identify potential ways to minimize their tax burden. Corporate accountants are essential in helping businesses adjust their financial and tax planning strategies to mitigate the negative impact of tariffs. 7. Changes to cost allocation methods. Tariffs can also lead companies to adjust their internal cost allocation methods. For businesses that import materials or finished goods, the additional tariff cost may need to be reallocated across departments or products. For example, if the cost of a particular component increases due to tariffs, the company may need to allocate those increased costs to the specific products that use that component. This adjustment affects the internal costing systems and may require a revision of pricing models for both customers and internal reporting purposes. 8. Impact on profitability and earnings forecasts. The increased costs of tariffs can also significantly impact a company's profitability, particularly in sectors that rely heavily on imported goods. Accounting teams must revise earnings forecasts to reflect the impact of tariffs on profit margins. This can include recalculating expected revenues and expenses, adjusting financial projections, and revisiting earnings guidance provided to investors. The impact on profitability may influence stock prices, which in turn may affect how businesses approach their financial strategy in the short and long term. 9. Currency exchange risk management. For U.S. businesses that operate internationally or import goods from countries with fluctuating currencies, tariffs can introduce additional currency exchange risks. When tariffs increase the cost of goods from foreign markets, the company's exposure to currency fluctuations also increases. This may require adjustments in how companies manage foreign exchange risks, such as using hedging strategies to mitigate the potential impact of unfavorable currency movements. Corporate accountants may be involved in reevaluating the company's approach to currency risk management to protect against volatile changes in the value of foreign currencies. 10. Strategic shifts in supply chain and sourcing. Tariffs often lead companies to reconsider their supply chains and sourcing strategies. When tariffs make certain foreign goods more expensive, businesses may seek alternative suppliers or move production closer to home to avoid tariff costs. Corporate accounting plays an important role in assessing the financial viability of shifting suppliers or production locations. Changes in the supply chain can affect everything from inventory management to vendor relationships, and accounting teams are crucial in evaluating the financial implications of these decisions. The ongoing tariff disputes and their implementation in U.S. trade policy have far-reaching effects on corporate accounting practices. From adjustments to financial reporting and tax planning to revaluing inventory and managing cash flows, businesses must navigate these challenges carefully. Corporate accountants play a vital role in helping businesses understand the financial implications of tariffs and adapt their strategies accordingly. As tariffs continue to evolve, companies will need to stay agile and proactive in adjusting their accounting practices to minimize the impact on their bottom line. The ongoing global trade tensions underscore the importance of robust financial planning and strategic accounting in maintaining business success in an increasingly complex economic environment.